Ever had that aha moment when you finally think you've cracked the secret code of price action, only to have the market flip you the bird? Yeah, welcome to the wonderfully vague world of trading with price action. It's like trying to decode ancient hieroglyphics with one eye closed. Looks simple on the surface, just candlesticks, right? But let me show you why price action might be less of a crystal ball and more of a broken compass, if you're not careful. Let's be real, price action is like art, totally open to interpretation. You see a strong trend forming. Someone else sees a sloppy mess. The worst part? You can convince yourself to enter almost anywhere, which feels great, until it isn't. If it's a winning trade, you pat yourself on the back. But when it's a loser, good luck fixing a strategy you can't even define. And scaling up? Forget it. How are you supposed to double down on vibes and feelings? You're better off flipping a coin. Price action is basically code for you're about to spend an unhealthy amount of time glued to your screen. Want to take a quick break? Too bad, that perfect setup only took a second to slip by. Every little movement looks like the one, until it drains your account like it's a leaky bucket. So yeah, hope you like watching every candlestick flicker while the rest of your life goes on hold. If there's one thing price action is great at, it's making you second-guess every single move. Welcome to the world of fake breakouts, choppy waters, and enough false signals to make you question your sanity. It's easy to fall into overtrading because, hey, every fake out looks legit, until you're drowning in losses and wonder where it all went wrong. Trying to backtest price action? Good luck. Without hard numbers, it's like trying to measure fog. One day you're buying dips, next day chasing breakouts. Consistency is a myth when your strategy keeps changing. So instead of improving, you're left spinning your wheels, wondering why the market feels like it's out to get you. If price action were a person, they'd be that one friend who makes every situation exciting and usually leaves you regretting all your life choices. Without rules, you'll fall for every minor move, thinking it's your golden opportunity. Spoiler, it's probably not. Even with strong discipline, you end up doubting every call you made. Trust me, I've been there. Had to watch prop firm accounts go up in smoke because I was too confident in my instincts. So here's a crazy idea. Structure. Because price action is already subjective enough, you're going to need clear rules to keep yourself from guessing. This could be anything from specifying how many candles confirm a reversal to what actually counts as a trendline break. Personally, I'll look at the daily time frame first to see the bigger picture. Let's say it's an uptrend. Great, now just sit back and wait until price reaches support before you touch a trade. See? It's not rocket science, but it will save you a world of pain. Alright, so once price finally reaches your daily support, switch to the hourly chart and look for a double bottom. That's right, a simple, classic double bottom. Before we jump into the real chart, let's see how I specifically looking for the double bottom in theory first, because the common mistake traders make is that they jump in too early. First, let's say this is your hourly chart. We need to wait for the double bottom to form first. Okay, the retracement is coming, but we don't know if this is the first bottom yet because price still can go lower at this point. To the seller on this hourly chart, it's still a sell. The trick is to be patient and wait for price to actually confirm. And don't just jump in because you saw two bottoms touch. Wait for a retest of the resistance break. It's logical. If price is truly reversing to the daily trend, it should show signs of struggle around that support. For me, I sometimes wait for a mini range before jumping in, but that's more advanced. Stick to the double bottom retest for now, or you'll just end up chasing shadows. Alright, now let's see how this looks on a real chart where things get interesting. We've already seen the daily support level marked out, so let's drop down to the hourly chart. Now, here we are, looking for that double bottom we talked about. Notice how price is testing the support once. This is where most traders jump in too early. At this point, price still could make lower low because nothing is broken yet. But what do? We wait because we need a second bottom for confirmation. Is this the second bottom that we're looking for? Let's see if it can break this area here. Personally, I prefer it breaks this area instead. To me, it really showing signs of buyers taking back control. It also defines the willingness to push the price back to its original trend. Oh, it didn't make it. Price went lower. Standby. Price went back up and challenging the sellers. Interesting. Oh, it went up now, but we still on standby mode. We need to see the double bottom to form again. This one is not a double bottom because price breaks lower. You see, the price is testing the support area again, but the seller is strong. Let's see. Sellers got rejected again, and they try to take back control. We might get our second bottom now. Yeah, this is our second bottom. But wait, no entry yet. Be patient. Okay, we still need more information. I think they are back. This is it. Now, let's set the stop loss. Conservative traders might want it below the recent low. Aggressive traders can use a tighter stop near the retest area. You might be thinking, why am I allowed to set a stop loss this tight? Remember, if the price breaks back down, it's likely going range-bound again. And when it goes range-bound, patience is key. Just wait it out or move on to the next setup. Okay, let's check how the outcome. Price went higher. I hope you can see the overall concept is, in a nutshell, what you really need to understand here is price went lower and reached your support level. Price stopped making new lows. Eventually, price turned back up, and usually you would see the final mini range happening first before it takes off. This is where you need to start calculating your risk and do the entry. I know it might a bit confusing. In case this is too advanced for you, maybe can try some of the other simpler variation and see if it fits your personality. But still, I personally would use the advanced method as I prefer to have a tighter stop so that I could have a more realistic risk to reward ratio. Okay, the simpler variation would be to use a pin bar or bullish engulfing candle. That's it. Very simple, right? Not necessarily means it's good though. So you can try using these once it reached the support area. Remember the structure as we discussed before. Only take those that at a support level. If you choose to use simpler method, please don't look for a pin bar or bullish engulfing anything lower than 4-hour chart. Personally, I would just stick to the daily chart. Why? Because you didn't give it a chance to go through enough the test of time. And remember, candlesticks pattern at the end of the day is still just a candlestick. There's nothing magical about it. It's just a rules that you set yourself in order to build consistency. So, unless you like sitting at the corner of your room crying, stick to these two time frames, preferably the daily chart. If staring at charts all day isn't your idea of fun, define your trading hours to match the active periods that fit your schedule. Limit the number of trades per session. Overtrading is a great way to kill an account. For me, anything below 1 hour setups is just noise. I prefer the higher time frames. Swing trading, that's my sweet spot. letting me avoid staring at my screen 24/7 like I'm guarding some ancient treasure. I could give you 1,000 reasons not to day trade, but let's save that rant for another time. Think backtesting isn't possible with price action? Think again. Identify your key setups and run them through historical data. This gives you a sense of how your strategy works across different conditions. Just remember to structure your setups, so you're not constantly wondering, is this my setup? I start by setting clear support or resistance levels on the daily time frame. Structure is your friend here.
Dun dun dun.
Here's where the real magic happens. Reflection. You need to know what's working and what's dragging you down. Start a journal, even if it's just for tracking your emotions or noting patterns you're seeing in your trades. Now let's talk control. You can control how you enter, when you enter, and most importantly, how much risk you're willing to put on each trade. What can't you control? The outcome. So plan ahead. Know your exit strategy for each trade before you even click buy. Remember, your exit is what ultimately decides whether you make money or lose it. Reflect on what's within your reach and let the rest go. Tired of checking charts every 5 minutes? Let's automate some of that hassle by setting alerts. Here's how you can set it up on TradingView so you'll only get pinged when things are close to happening. First, find your support or resistance level on the chart. Let's say we're using this line right here. Right-click directly on that line, and you'll see an option for Add Alert pop up. Click on it, and a new window will appear where you can customize the alert. Choose the condition, whether you want the alert when price crosses the line or only when it touches it. You can also decide if you want it to alert you just once or every time the price hits that level. For a bit more control, set the expiration and choose to receive the alert by email or directly on your TradingView app. Once you hit Create, your alert is set, and you're free to step away without that FOMO feeling. This way, you can focus on other tasks until the real action begins. So no more staring at charts all day. Let the alerts handle that for you. If you're new to price action, don't be the hero who skips demo trading. The market isn't going anywhere, and the best way to build confidence is by practicing without risking your hard-earned money. I'd like to assume you already know this, but hey, it bears repeating. Here's the big one, but only if you're ready for it. Understanding fundamentals. If you're just starting, don't overwhelm yourself. But as you get better, remember, what you trade is as important as how you trade. Be aware of upcoming news, and if you don't get it yet, skip trading during those times. Fundamentals aren't as scary as they seem and could be the filter that keeps you from chasing bad trades. Alright, so that's my take on the dark side of trading price action. Again, in case you want to implement this type of entry method in your strategy, please backtest it before you trade it with any real money. This entry method still has flaws. You will notice it in case you have tried it, especially in a choppy market like any other type of strategy. The main key takeaway here is that trading price action sometimes can be vague, and this can lead to inconsistency. So, you need to put some structure to trade price action more effectively. Feel free to adjust it so that it can fit to your personality. Personalization is very important. Let me know if any of this hit close to home for you and drop a comment if you've got your own take on price action trading. If you found this video helpful, remember to hit that like button and subscribe for more of these realistic takes on trading. And hey, check out my other videos too. They might just save you a lot of time, money, and sanity.